look, in early June, you were worried about inflation, but kind of said the Fed was in a good place, and now you seem like you've changed a little bit. What's your outlook for policy now?
Well, it's a good observation. I think inflation has softened a little bit during that time period that you're talking about. And, over a slightly longer, period, you go back to since the Fed started raising rates, I was always a little nervous. Was this the right time to start raising rates? I think early on, 2015, December it was, 2016 it was. But, I was worried, was inflation going to get up to 2%? Our objective, which is symmetric, so we should be above 2% sometimes and below. And I think it's worked all right. There was a moment, there was a period of time after, one of the big phone companies had big reduction in their data rates, and the CPI, the data, was very light for a while. Was that temporary? Was it something else? And, we've been under 2% for a long time, so I've been worried about it, and then, sort of with the most recent nervousness, I'd just say, I think that a little more accommodation would be helpful for ensuring that we confidently get to 2 and above 2%. I really think that 2.25 or a little bit more than that would be about appropriate for our economy and monetary policy. At this point in the economic cycle, we're 10 years into an expansion, and if we're ever going to be above 2% during this cycle, you would think this would be about right.
I will say you have been very consistent about your concern about what you call the symmetric inflation target, which I guess means if you run a little bit under 2%, you shouldn't be too concerned if you run a little bit over. How much help does the economy need from the Fed in getting to a 2% target?
Well, that's a great way to ask the question, because there are other ways that we could get to 2% if we had even more stimulative fiscal policy, or if the state of the global economy was much stronger so that increased exports. If the state of the economy was even stronger than it is now, and it's really quite solid, if there's other additions to aggregate demand, that tends to increase inflation, and then the Fed wouldn't have to do as much. At this moment, the way the economy is going and the state of anchored inflation expectations, we just seem to be a little bit less than 2. It's not bad, really. I mean, I think it's a danger for the strategy of monetary policy if it's perceived that we can't get up to 2%, and 2% is thought of as more a ceiling. But, other factors, stronger business environment where investment increases, more people coming into the workforce, growing economy, that would tend to lift wages and lift inflation. And so we only really should be doing as much as is necessary, but at the moment it seems like a little bit more is necessary.
The market debates, I think, the following issue. If you were to cut in July, is it a one-and-done thing? Is it more than one 25 basis point rate cut that's needed? Or do you do what has been talked about? No less than the Fed chairman has talked about this idea of an ounce of prevention is worth a pound of cure, which is as you get down towards zero, the Fed ought to act early and act forcefully. Where do you come down on those three issues?
They're all important. I think that
you can't do all three at once in July.
I think that we need to, have our strategy in mind, and so I think that it's very important to ratify and be very affirmative that inflation can go above 2%, that it's not a ceiling. And I look at the forecast that I was asked to submit in June, and in order to get inflation up to 2.25% over the next 3 years, I needed 50 basis points of more accommodation. And in fact, maybe that's not quite enough. I kind of think that would increase inflation expectations, and that would help. So on the basis of inflation, last time I was on talking with you, I had the same story, which is I think inflation itself is enough. Now you talk about an ounce of prevention because the global economy is weaker than certainly it was in 2017. 2017, it was very strong. And now it's moderated and it's a little bit weaker. So that's not a source of strength. And so from a risk management standpoint, it makes sense that you might think that we're a little bit more restrictive because of that, and we need to be even more accommodative.
You didn't mention trade in that list of things that you're concerned about.
Well, the global economy is weaker. There are trade uncertainties. Obviously, the administration is pursuing a different trade strategy where there's aggressive use of tariffs, brinksmanship, trying to get other countries to alter their policies, and we'll just have to see how it works. It's a different style, but that comes with adding more uncertainty, and you're never quite sure how the other party is going to react, and so It's not what I do for a living, but in terms of how you think about businesses must be reacting to the overall environment, it seems like this injects uncertainty into their decision making.
I think the sum of your answers already answered this question, but I just want to be clear about it. You would still be an advocate of easing policy if there was suddenly a deal between China and the U.S.?
Unless I had great reason to think that that would somehow create a lot of inflation, yes, I think that's right. I think on the basis of inflation alone, I could feel confident in arguing for a couple of rate cuts before the end of the year.
All right, one more question on near-term policy here. I paint the following picture of this fictitious economy. Unemployment near a 50-year low. A recent payroll number that was well in excess of expectations. A strong retail sales number just this morning. Economy running roughly at the central bank's view of potential growth. Inflation 0.3 below the Fed's target, or the central bank, the fictitious central bank's target. You give me that stuff on a piece of paper. I don't go from there to you need to cut rates. How do you explain or cut rates into an environment where it seems like the economy is doing reasonably well?
I was expecting you to say the opposite. I was expecting you to say that's exactly the argument for a rate cut. The economy
That's why I'm not on the board.
The economy,
among other reasons.
Right. Economic fundamentals are solid.
Right.
If what we really mean is we're supposed to provide monetary and financial conditions to promote maximum employment and price stability, and price stability is symmetric, 2% inflation, we need to go above 2% at some point, or else I'm worried everybody out in the audience and around the world is going to go, that 2% certainly looked like a ceiling, didn't it? They really were worried about going above 2%, weren't they? They were under 0.3 under 2%, and for how long? I mean, we haven't cracked 2% on a sustained basis since the Great Recession. And, if you don't do that, I worry a lot. Yeah, I don't want anybody to think that we're in a position like the Bank of Japan where they got really nervous about all of this and they've been, dealing with it. I think the European Central Bank has been a little bit better, but behind what we've done at the Fed. So, I think those are the issues.
One more follow-up. I'm sorry, folks. I do want to move on to the broader questions. But you said 50 basis points of tightening is what you think is needed to bring inflation back up. Do you have a sense of the timing of when that 50 basis points is needed?
The kind of exercise that we do, it's not so critical. I said before the end of the year. But I think what's the way that I think about this is I look at the forecast and what is it that's necessary to generate 2.25% inflation at least. And 2.5 is okay too, because we've been under 2% by more than half a percentage point. If you were to average 2 over some period of time, I think the way that this would likely happen would be consistent with a definition of symmetry. We probably need to work a little harder at explaining what we mean by symmetry, because I think everybody has a slightly different idea in their mind. I think part of the monetary policy conference that we were thinking about is kind of geared towards understanding that, or at least that's how I see it. But so I think that if 100 basis points got us to 2.5, well, that's still consistent with symmetry. I think a lot of this is, how is the committee thinking about this? How do the members come into the meeting? What's on their mind? I will say that it's a little lonely to be talking about symmetry and, it being above 2. We all say, yeah, it's symmetric, but when you start explaining what you think is consistent with that, mine is a bit more picturesque on the upside relative to, quite a few people. So that's why we go into the meeting, all participants talk, and we'll come out with a strategy. I would think we would be well served by overshooting 2%. I definitely think that we need to work hard to do everything that we can to get to 2%. With confidence.
We are going to get to this issue of why and the connection of the labor market to inflation, which is critical. But I do need to ask one other question, which is about President Trump, on a nearly daily basis now, criticizes the Federal Reserve Chairman and the Fed itself. He said that if not for Fed policy, we'd be growing faster. He said that this morning. Is that true?
I think we've had a tremendous amount of stimulus for the economy. We had a big tax cut, tax reform. They added more government spending. That's sort of been waning now with the effects of that over a couple of years. And so we're coming down to trend growth. I mean, I guess the short answer is if you had more accommodative policy, you would guess that would stimulate the economy a little bit more. I think that the path for the economy at the moment is one towards trend growth. I think trend growth is about 1 3/4%. We're looking at 2.25%, 2 to 2.25% growth this year, maybe 2% next year. That's slightly above trend. I don't think we should be in the business necessarily of generating excess stimulus in order to get growth up. We want to continue the expansion. There's no doubt about it, but find the right balance. It does turn out that because inflation is undershooting, that's a fine thing to do. So, yeah, I guess I am kind of saying, yeah, it would have been stronger if we hadn't raised rates. There can be an argument for that. You got to be very careful in how you think about it. And there's so much else going on. I think the risk management argument is really a good one. Economy's solid. I don't really want to be talking down the economy because I don't think that's the state of the economy. It's just that there are a lot of risks out there, and there's Brexit, October 31st. No deal Brexit seems to be back on the table if I understand some of the discussions of the future prime minister. Who knows how that plays out unless they also get some type of new deal from the EU. So there's a lot of uncertainty.
President Trump's been unique among the past 3 presidents, but not perhaps before that, in commenting on the Federal Reserve. How do you feel about the idea of the president talking and advising in sort of strong words what the central bank should be doing?
We've got a job to do. We have to pay attention to the economy. We have to go out and explain why we're doing it. We have to explain why this policy is good for the state of the economy. Fundamentals are solid. So I think we've got a good story to tell, even with maybe an ounce of prevention is the right measure at this time. So I think it just, it goes with the territory, sometimes more than other times. But look, I think when you go out and state the case very strongly, which I think is very important, central bank needs to be independent. We need to have some distance between us and short-run political pressure because somebody's got to make hard decisions when the economy needs something that other folks would say, oh, no, that would be too hard. Paul Volcker needed that measure of independence in order to raise rates to get inflation down in 79 through 82. And so when you ask for independence, perhaps somewhat arrogantly, I think you're saying, look, I'm going to be accountable. You get to criticize, and you got to have a thick skin.
Let's pivot from that. And it's not really that strong a pivot because it really cuts the economic argument cuts to the heart of the political argument, which is how fast should the economy be allowed to run? How low can unemployment go? And one of the things that I have seen over the time, and I've been covering the Fed for like 20 years now, is an extraordinary decline in the kind of acceptable run rate of the economy when it comes to the unemployment rate. You guys used to be freaked out at 6.5%. And then it was kind of 5.5%. And then it was 4.5%. And now, as I talked about earlier, you're about to cut rates with the unemployment rate near a 50-year low. And the fundamental underpinning of that is that the unemployment or the low unemployment is not producing the expected inflation that you thought would come. What happened? Has everything from the macro textbooks, you just take out the first, 112 pages? Is that what we're doing here? And we start in the middle?
Another great question. I think I probably start all of these responses the same way, don't I? Because they are. There's so many ways that I could, respond here. One, our job is to keep inflation, at 2% symmetrically. I have to admit to you the inflation-generating process is one fraught with uncertainty, and so we rely on a whole bunch of things. In the old days, Milton Friedman and others would point to monetarism and look at money growth rates. Money growth rates don't work, haven't worked for a long time. We sort of look at labor slack in the economy with the idea that when resources are used quite a lot and they're very scarce, then the price of that scarce resource gets bid up. And if it's labor, then wages get bid up, and then that gets passed along. So you have
Let me stop you there, Charlie.
But the Phillips curve explanation hasn't worked very well.
This gets right to what I think is the interest of people in the audience. On the one hand, you have low unemployment and a scarcity of workers, or growing scarcity. On the other hand, you don't really have wages going up that much.
Yeah, so it gets at what we mean by scarcity of workers. I talk to business people all the time. For a number of years, I've heard it's really hard to find the talented workers that they're looking for. It's hard to find workers with the skill sets that they're looking for. It's a new skill set that's in high demand in the workforce, and people who don't have that skills, they're not in such demand. So how do they fit in? What's their next best alternative? What type of retraining might they need? How well is that going to work out? It's very complicated, very difficult. And wages, even with a low national unemployment rate, 3.8, 3.7, we haven't seen strong wage pressure. We've seen good wage growth, and productivity is not as strong as we would like. And so in line with a little bit lower productivity, wage growth has come in. But still, it could be higher, I think, with a higher inflation expectations. And so there's an argument that we're not really pressing the true scarcity limit there, that maybe the natural rate of unemployment is lower than what we've been thinking about. That's why I think we're well served by the dual mandate. The dual mandate says, look for sustainable growth, look for maximum employment, but also balance this against price stability. Inflation is lower than our objective. We would be well served to be a little more accommodative in the pursuit of getting inflation up, and it is well aligned with continuing to provide opportunities for people in the workforce that have struggled to find good opportunities. People on the lower end of the skill set are in demand. They're finding jobs. People middle income and below that are finding good opportunities, working, reinforcing their attachment to the labor force, which ought to have a longer lasting effect even beyond this cycle. And the longer this cycle lasts, the more opportunity there is. So I think those are messages that came out of our Fed Listens conferences from the panelists, people in the community. I love the question that my colleague Eric Rosengren asked the panelist, is it possible that unemployment rate could maybe go too low? And then, when it comes back up, that generates all kinds of problems. And I think the fellow was Marcus Jones, a big, he'd worked at Lisk, and it was sort of like, well, a lot of times in the neighborhood, it always feels like a recession. So, it's feeling better now. Let's keep this going. And I think there's more opportunities.
I thought you were going to say, can the unemployment rate have a two-handle on it?
I'm not in the game of trying to figure out exactly what that number is. At the moment, it's just sort of, I'm not seeing the inflation pressures.
And until
I'm not
you do.
seeing a great, yeah, that's right.
Interesting.
That's right.
Let's talk about the workforce, which is changing. And I remember Alan Greenspan years ago made a joke at Jackson Hole. He said, we don't know a lot that's true about economics, like in physics or stuff like that, but we do know one thing. The vast majority of people who are 35 now, 30 years from now, will be 65. That was a pretty good economics joke. We don't have many good economics jokes, but that's one of them. And you guys can use that, but quote Alan, don't quote me. But we have this changing workforce here, and I was always feeling pretty good being born in 63 because I'm the last year of the baby boom, which means I'll always have a job but never be able to retire. That's my take on the world here.
You don't want to retire.
I don't love my job. But tell me about the way that you think about the demographics of the workforce. Who, and I'm going to say what, will power this economy in the coming decades?
So this has been, a long economic cycle. It's been a long recovery. It's been marked by relatively slow growth rates, 2%. We have, over a long period of time, enjoyed average growth rates during expansions of 3.25% I just said earlier that trend growth looks to me like 1.75%. There's a big difference between those things, and more growth covers a whole host of problems and sort of allows more people to enjoy that. So, why can't we have, why are we looking at 1.75%? And productivity is not quite as high as you would like, although it's way better expected to be than 1973 to 95. But on the labor front, you've got the baby boomers aging.
Retiring.
You've got the demographics. You've got female labor force participation, which added a lot of lift to the growth of the economy in the 70s, 60s, 70s, and 80s, and into the 90s. It's flattened out, so it's not adding more growth. It's just women participating more. So that's another reason why we're not getting as strong a growth. Younger people don't have the same attachment to the workforce, 18 to 24, that they used to have, so they're providing fewer labor hours too. So you put that together and you kind of go, going forward, it looks to me like labor input growth is going to be 0.5% annually. 0.5% plus 1.25% productivity growth gets you 1.75%. Now, demographics are driving so much of this. So, what if you want 3? What's the public policy argument for how you get to 3? Well, you got to work on both that productivity and labor. Productivity is very hard. Computers, integrated circuitry didn't lead to stronger productivity until like the 90s. Labor, though, how do you get more labor input growth when the economy's aging? More people are coming into the labor force. More people are working. Over the age of 65, you're exactly right. You don't have to retire. You might not work full-time, but more people are working. I kind of wonder how much of this is exactly what they were wishing for 30 years ago or 10 years ago, and the fact that we had this great recession that hurt people's retirement. Now you're hitting retirement, but one way or another, people 65, 55, and they're working a little bit more. There's reason to suspect that there might be more slack, too,
right,
if people are working part-time with like full-time. People are out of the workforce because they're looking for a full-time job, and then they jump to that. But, I mean, how do you get labor input growth? You can't just birth 25-year-olds.
Babies, or you got to have immigrants.
But you can't birth 25-year-olds. So if you get the growth rate up tomorrow,
pass over that whole nasty period there.
This will help you.
But it sounds like your argument, which is a fascinating argument that I hadn't thought about, because everybody talks about labor or robots. It sounds like your argument is we need lots more labor and we need more robots.
That's probably the case. It's unlikely that you're going to get it on only one dimension.
We need more tech to drive up productivity. We need more people to work.
You want to fill in 1.25 percentage points? If you're satisfied with 3, a lot of people at this point would go, I can give you 4. You need more. This is sustained, not just for 1 year, not just for 2 years, not just a sugar high, but something sustained. You've got to grow the workforce more, and you've got to grow productivity more. I mean, look at Japan. Japan refused to expand immigration, and they've had terrible.
But they have a lot more robots than we do per capita. Just so you know.
Necessity is the mother of all invention, right?
We have a little bit of time for questions, folks. Does anybody have one for President Evans here? Right over here.
I have a leadership question for you. So much news coverage has been devoted to Trump's war on the Fed, and when I think about that in the context of our business, it's kind of the equivalent of the chairman of our company publicly undermining the CFO of the business. How have you kept morale up through the process of what Trump has publicly been stating in recent months?
Well, it's a little bit like what I was saying earlier, which is, Congress and the president, there's a history of providing a level of independence to the Federal Reserve, letting them do the job that they need to. There is a history of being criticized by the president. I thought it went back much further, but I was interested when I read Don Cohn make some remarks at a Brookings conference that sort of said, well, beginning with sort of the Clinton administration, presidents have gone quieter in criticizing the Fed. And so, there have been times where, there's an awful lot at stake when you're president, right? I mean, there were claims that the chairman of the Fed and Richard Nixon got together in the 70s before the 72 election. There were certainly concerns that policy was different in order to help one side, to get the economy going or something. And so I think independence is important. Take us out of the political calculation. Let everybody question us, question the chair, talk about why we're doing it. Learn from people's comments. When the president says that, if rates had been lower, growth would be stronger. I mean, there's an element of our economic analysis that's right, in there. The question is, what's the right policy? How are we thinking about it? And, we're doing the best that we can.
There's right here.
Hi, Sydney Dillard, Lib Capital Markets. Just wanted to ask a question. You talked about kind of that there aren't enough folks participating in the workforce, and I wanted to talk specifically here in Chicago, when you look at kind of the most underutilized and with the least amount of access to jobs are the minority communities, right. And that's probably the case really across the country in major urban cities. How does that factor in? What are your thoughts about that in the context of workforce participation and how you actually add people to the workforce?
Yeah, that's a great question because that's definitely a concern. I mean, unemployment rates for underrepresented minorities are higher than the national average. How do we allow everyone to enjoy the benefits of the economy if the economy is growing, but only for 10, 20, 60% of everybody who's participating? That's not right. So I would say that it's a really hard issue in the sense that I think so much of it is local. In Chicago, we've put a lot of effort into the Chicago financial services pipeline, and so there's a great interest in getting more African Americans and Hispanics, getting representation for women to the right levels within financial services. There's an argument to broaden it beyond that, into all professional services and beyond. But 17 financial institutions have come together, had consultants look at our labor market structures in the firms and offer some pointers for, how we improve things. And a lot of it makes, perfect sense. Get more people in. Make sure people don't leave for the wrong reasons. Make sure that they're engaged and they have opportunities, that they have champions within the organization, and that they're given positions so that they can meaningfully have an opportunity to move up, and then you get better representation at all the levels. I think that programs like that, no matter how narrow they might be within one industry, have tremendous, they show a light as to here's a program that seems to be working, or it offers opportunity. We got a lot of work to do, and maybe it could be a model in other places. So that's some of the way I think about it.
We have time for just one more. There's one in the back here.
I would appreciate your comments about government debt and how it might potentially be squeezing us in the future. I'm thinking primarily August, September timeframe.
Okay. Those are two kind of different issues. One is the overall level of debt. The other one is the legal law that we have that even if you've appropriated the funds and gone out and spent it, you're not, you still have to, keep the debt under that, even though you've already said it's okay to go past that. The debt ceiling, I think Congress and the president have to get together and figure out, how to get that extended. I think that's very important. I think that's another, issue that makes everybody nervous. We've been going through more intense bouts of this going back to 2011, I would say, and it's not helpful for the economy. I think that when business leaders and people working have to think about, wow, how's this going to play out? 6 months after that, if we've already shut down the government over other issues, and so I just don't think that that's helpful. In terms of the debt, that's a really difficult question. We certainly have very large deficits. Congress and the president have agreed to continue that tradition of extending those deficits with the most recent tax reform, and so I'm not quite sure what the next level of thinking is. I'm looking and listening, both as a Fed person and just an American citizen, really.
I have done here what I do every day on television, which is anger my producers by going over my time cues. So I'm going to have to end it here. Please join me in thanking Charlie Evans.
Thanks, Steve.